OK, well, let's get to a reaction to that number from Paul Mortimer-Lee, Global Head of Markets Economics at BNP Paribas. Good morning to you.
Good morning.
The figure's higher than expected. What do you think pushed it up slightly?
Well, government spending was up a chunky 1.2%. Seems to have a bit of a pre-election spending binge there. But consumer 0.4%, I mean, better than the average. And exports were pretty chunky at 3.7%. So clearly some benefit from the pickup in global trade, though there's a subtraction from imports. Imports are up quite heavily, to be honest, up 4.1%. But it goes in the way that we expected. There would be an upward revision. I don't think this will be the last upward revision. I think overall we'll probably see at the end of the day a 0.4 in subsequent revisions to this, because we've seen from the labour market that has kind of stabilised that growth had to have been better than the statisticians have been reporting, and this number confirms that.
So does this mean we are less likely to see the double-dip recession that's been predicted by some economists?
No, I don't think so. I think there are a number of favourable things at the moment that are helping the UK economy. There's the bounce back in global manufacturing, there's probably inventories, there's a big benefit to the consumer, has been over recent months, from the fall in mortgage interest rates. And the government has been spending quite heavily. Now, most of those things won't last. So interest rates aren't going down anymore, so the benefit to growth of consumer incomes will fade. The government is borrowing from the future by spending now, have to spend less later, and inventories can't add to growth forever. So I think we'll see stronger growth in Q1 than in Q4, but by the end of 2010, I think we'll see growth coming off. And then what matters very importantly is how big the fiscal tightening is that the new government will have to deliver after the election, and crucially how quickly that will come in. So we could see a double dip. I don't think we'll see negative growth again, but I think the immediate outlook is very good, but the outlook at the end of next year starts to look rather softer again.
You talk about increased government spending in the run-up to the election. Of course, it will be a bone of contention when the deficit is tackled. Do today's figures give any hint as to which side is more likely to be right? Should the deficit be tackled straight away or left for a little bit?
Well, to the extent that growth is coming in a bit stronger than people expected, it gives you the room to tackle it a little bit earlier. The crucial thing is what can you get away with in terms of the markets? You know, the government's current plans are that the debt-GDP ratio doesn't stabilise until the middle of the decade, basically. And for the markets, I think that's too long. I think unless the budget is tightened after the election, I think we'll see a bad market reaction and the government will be pushed into delivering more. So I've got to say that for the UK, I'm very much in favour of a quicker tightening rather than the slower one.
Okay. I'd like to move on now and talk a little bit about Europe. Greece, is what's happening in Greece at the moment really slowing down any pressure on the ECB to exit its stimulus package?
Well, I think the ECB, yeah, it is, because clearly the thing that the ECB is thinking about over the course of this year is not really raising interest rates. I think that's ruled out. We've seen the German inflation numbers this morning coming 0.4 less than the market was expected. So German inflation going down to probably 0.4 year on year. There's no rush to raise interest rates. But the ECB would like to normalise its money market operations, take away some of the excess liquidity. And clearly, if the stress in European financial markets, including govie markets, that's bound to make them go slower than they would do otherwise. I think we've heard from Mr. Trichet, it's going to be a very gradual process. And if there's stress in govie markets, it means it's going to be even more gradual, and appropriately so.
It is Portugal, Ireland, Greece that are really slowing down the growth in Europe.
Well, absolutely. You've seen it's not particularly good for consumer confidence when people are talking about crises in the fiscal accounts and more tightening. But we saw in the recent German GDP numbers, the only growth that came from exports, and that's what's really lacking in Europe is domestic demand. And there's a big difference between Europe and the US, where the consumer is not strong in the US, but at least there's some consumption, investments picking up, so there's domestic demand. In Europe, that's totally absent, which is why any financial crisis, when the patient's already weak, another infection hurts them very much. And so I think that what's going on in Europe at the moment is very unsettling and is likely to reduce growth, maybe even below 1% this year.
Paul Mortimer-Lee, thank you very much for joining us this morning.
Pleasure.